welcome back to the session on Fundamentals of Financial Management. I, Dr. Neha Seth, working in the capacity of Associate Professor with Symbiosis Institute of Business Management, Symbiosis International Deemed University, here to share with you my views on fundamentals of financial management. So in previous session, we have started with the basics of financial management, wherein we have seen what do we understand by the term finance, how it is impacting the working of an organization, what is financial management, how financial management is related to various other disciplines of management. We have seen what were the functions of finance. So in summary, I will show that how financial management is related to other discipline. So we have discussed that there are different disciplines of management like marketing management, production, human resource, how it is impacted by financial management or how these disciplines are related to financial management. There is further classification of these management disciplines as primary discipline. So primary discipline like accounting, macroeconomics, microeconomics, these kind of discipline are also impacting the financial decision area. It is also well said that where accounting ends, financial management starts. So once we have done with bookkeeping and recording of all accounting transactions, once our books are ready, once our financial statements are ready, now the role of financial manager starts by analyzing these financial statements and taking decisions based on these financial statements. So these are the primary disciplines that impacts financial decisions. There are other related disciplines also that we have discussed in the previous session like marketing, production and operation, human resource. These disciplines also support the financial decision areas. What kind of decisions which are impacted by these primary and related discipline? Decisions like investment analysis, working capital management, sources and cost of funds, from where we are going to raise the funds and what would be the cost that we have to pay for raising the funds. Determining the capital structure, what should be the ratio of debt and equity in our company. Dividend policy, how much amount we are going to pay in the form of dividend. What percentage of profit we are going to distribute in the form of dividend. What should be our payout ratio. Okay. Then analyzing risk and return. Okay. We will discuss these things when we are moving ahead. And these kind of financial decisions, why these are important? Because these are resulting into shareholders' wealth maximization, the ultimate aim of financial management. Okay. So we'll move ahead with the role of financial manager. So financial manager is a person who is responsible in a significant way to carry out the finance functions. Okay, in the previous sessions we have discussed finance functions. Now how these functions actually became the role of financial manager, this we will discuss. Okay, so when I say the word financing decision, which was a decision taken under financial management, but now how financial manager plays this in the form of his role is that he has to raise the fund. So this is the role of financial manager, that he has to raise the funds for the company. Okay, from where he is going to raise these funds? What would be the source of funds? Okay, at what cost? Nothing comes free in this world. So when the financial manager is raising the capital, a company has to pay some cost for these funds, for using these funds. Okay, and this is the role of financial manager to decide and to get that what would be the sources of fund and to minimize the cost of raising these funds as much as possible. Okay, so these are the financial function or financing function that a financial manager plays. Then he has to decide. There was a traditional approach when the role of financial manager actually ends here only. He has gathered the fund for the company, his role is over. Now the owner will decide where he has to invest and how he is going to utilize these funds. But the modern approach is entirely different. Now, not just raising the funds, allocation of funds is also the duty of financial manager. Financial manager will check, will decide that how these funds have to be allocated for different classes of assets. Okay, what portion of funds will go to fixed asset? What portion of funds will go to current assets? Okay, this will be decided by a financial manager. And once you have invested, the next thing is how we have to plan the profit. We have started earning profit now. We have crossed our break-even level. Okay, our revenue is good. We are able to meet our cost now. We are getting profits. But what we have to do with our profit? Should we give this profit to our shareholders in the form of dividend and make them happy? Or shall we keep this profit with ourselves and reinvest this profit so that we can help our company to grow further? Okay, so how to utilize the profit? This profit planning has to be done by financial manager. And now, since the companies are going global, we are not anymore operating in a particular region or a state or a country. Okay, the company is now getting international, going international. The globalization is happening. Okay, so a financial manager cannot remain unaware or uninformed about capital markets. So whatever is happening in capital markets, a financial manager needs to be aware of it. He needs to understand the capital markets really well if he has to take these first three decisions in a proper manner. So this is how the role of financial manager has changed from traditional to modern role now. So a modern financial manager needs to answer some questions. He needs to answer the questions like, how should the fund required be raised? In what form should it hold its assets? How large should an enterprise be? And how fast should it grow? If you can make out, these questions are pretty much related to the finance decisions or financial decisions that we have discussed in the previous section. Okay. So when I move ahead with this and we will see that what is the position that a financial manager holds in a company. So we can see that the topmost position or at the topmost level of a company, we have board of directors, then we have managing directors. Post that we have different departments and every department has its own manager. Like production department has a production manager, personnel department or HR department has HR manager, marketing department has marketing manager, and in between you can see there is a finance department which is headed by a finance manager. Finance manager has two more positions working under him. These are treasurer and controller. When I say the treasurer is responsible for auditing, credit management in a company, retirement benefits, cost control, etc. While a controller is someone who is responsible for planning and budgeting, inventory management, performance evaluation and accounting. These treasurer and controllers are the information provided to the financial manager based on analyzing these financial statements or financial information, financial manager takes the decision for the company, which is finally approved by top level management. So this is the position, a key position that a financial manager holds in a company. Now see, since the role of financial manager is changing, the goals of finance or financial management is also changing with time. So there was a time when businesses started with the mindset of earning profit. All they need is profit. If the business is profitable, business is able to generate profit, that is all a business is. That is all that was expected from a business. Later, this profit maximization thing or revenue generating thing has changed to the situation where the real picture is seen from profit after tax. Once you have paid all the taxes, once you have met all the cost and paid all the taxes, whatever left with you is your real profit. Okay. Then the picture has changed, further changed. Now profit maximization has moved to a situation when we investors and of course other stakeholders also talking about maximizing earning per share. They are trying to improve the earning that one particular share is going to give the investor. And the modern situation, the trend has moved further when we are talking about wealth management or wealth maximization. When the companies are focusing on improving wealth. So, profit maximization was considered as a short-term goal now. But wealth maximization is a long-term goal, which every company is now focusing on. What do we understand by wealth? Wealth is all the assets, whatever an individual or a company possesses. So when I say the word wealth maximization, I'm talking more about the shares that a company is having right now. Okay, so shares means there are number of investors who are interested, who have invested their money in our company. Okay, and how we can give back to them in the form of return. How we can maximize their wealth if the market price of the share is improving. Okay, so in a shorter way, if I'll say, or in other words, if I'll say, so wealth is something, number of shares which are there in the company and the market price of share. When I multiply these two terms, the amount that I'll receive is the wealth of my company. And the focus will be on improving the market price of the company. Okay, and this is how we are helping, we are supporting, we are returning to those who have trusted in our company, those who have invested in our company in the form of purchasing shares of our company. So the focus has changed from profit maximization to wealth maximization. We will discuss these things briefly now. So when I say the word profit maximization, it is maximizing the rupee income of the firm. The resources are efficiently utilized or not. This is something which is checked when we are talking about profit maximization. We are properly utilizing our resources. There is an appropriate measure of a firm's performance. We are able to measure the firm when I am talking about profit, because profit is something which we got after deducting all the cost from the revenue. That means we are able to meet our expenses pretty well now. So whatever we are earning is profit. This is one of the appropriate measure of earning firm's performance. It serves as the interest for the society as well. This is how the society see a company. But it is vague method or vague situation with which we are judging the company, because it ignores the time value of money. When I'm saying profit, I'm talking about today, what I'm earning today, what I'm able to extract from my company today. I'm not talking about long term. Okay, it is ignoring the risk. It is not feasible for new business to start earning profit from day one. So we are not able to judge the performance of new business, that means. So that is why the priority has been shifted from profit maximization to maximizing earning per share. So maximizing earning per share implies that the firm should make no dividend payment so long as funds can be invested at positive rate of return. Such as policy may not work always. Okay, and this situation also ignores the time value of money. In further sessions we will see and discuss time value of money as well. But this situation where we are talking about maximizing earning per share, it is ignoring time. It is ignoring risk as well. Okay, so maximizing PAT, that is profit after tax, or EPS, does not maximize the economic welfare of the owner. Okay, so the focus is shifted from maximizing EPS to maximizing shareholders' wealth. When I am saying shareholders' wealth, I am talking about maximizing the net present value. When I am talking wealth maximization, I am considering the long-term scenario. That means what I am going to earn in future, in coming years. I am converting this value in present to analyze that what would be my situation in future. Okay, this will give me the clear picture. This will give me the real picture of my company. Okay, it also accounts the time. As I have mentioned that we are able to convert the future value and present value to take our decision. It also includes the risk. Okay, and it helps in maximizing the market value of firm's share. So that is why this is now the goal of financial manager, the long-term goal, maximizing shareholders' wealth. There is a term in between we have is risk-return trade-off. Okay, so as an investor, as an owner, we need to maintain a trade-off, a balance between risk and return. Okay, as an investor, we always try to reduce our risk. But then there is a famous saying in finance as well, more the risk we are going to take, more will be the return. So we need to take the risk if we want to increase the return. But up to what extent we can increase the risk? Okay, this is what we have to decide. We need to make a balance. And this balance that we need to maintain between risk and return is called trade-off. And financial decisions are majorly guided by this risk-return trade-off. Okay, there is a relationship between return and risk. How? Because return, the total return that we are getting comprises of two things, that is risk-free return or risk-free rate and risk premium. Risk-free rate is something we call compensation of time. This is what we are getting because we are keeping ourselves away from our money. Suppose we kept our money in fixed deposit. Okay, there is a minimum amount of return that we are getting from fixed deposit as well. But this is just a compensation because we are getting separated from my money. I am getting separated from my money. I am delaying my consumption of money right now for some nominal return. But if I am investing in equity, I am taking a little bit of higher risk. Okay, I am taking risk and when I have invested the money in equity, I am getting some additional return also, something more than what I am supposed to get from putting my money in fixed deposit. Now this extra return that I am getting is my risk premium. This extra return I am getting because I have taken that risk. Okay, so risk comprises of two things, that is risk-free rate as well as risk premium. Okay, this risk-return trade-off can be represented or can be understood with the help of this diagram. Okay, on x-axis we can see that risk is clearly demonstrated, while on y-axis return is represented. So we can see that the straight line which is there, this will remain fixed, this will not change, and this line represents the risk-free return. Okay, that I am going to get. This is the minimum amount that I will get if I am getting separated from my money. But I can increase my return if I am taking more risk. And this increase in return beyond risk-free return is my risk premium. Right? So this is the combination, and this risk-free return and risk premium, this total amount is my total return. Right. So this is how this risk return trade-off impacts my financial decision. So from fixed deposit, I maybe want to switch to equity because I want to earn additional amount in the form of risk premium. This is how my financial decisions are impacted. So in crux, if I want to see the overview of financial management, this is the diagram which is the best representative. We have started with the financial management thing. We have seen what is financial management. Okay, we have understood how it comprises of two terms called finance and management, how we are managing finance, how financial management leads to maximization of share value, how we have shifted from profit maximization to maximization of wealth for shareholders, and how this maximization of share value impacts our financial decisions. Okay, what are the financial decisions that we are going to take? These are the 4 decisions that we are going to take under financial management. 3 are long-term decisions, that is investment decision, financing decisions and dividend decisions. Then we have short-term decision also, we call it liquidity management or liquidity decision, or we also call them working capital decisions. And these decisions are taken to make a balance between risk and return, to trade off between risk and return. So this diagram is a clear-cut representative of how financial management works, from where we begin and where we have to go. Okay. Then we have a term called agency problem. Now what is this agency problem? Okay, now the manager, there is a relationship between manager and shareholders also, but there is a difference between manager and shareholders' goals as well. Why? Because there is a principal agent relationship between manager and shareholder, where management acts as an agent for the owners. Who are owners? The shareholders are the owners, and management acts as the agents for the shareholders. So the theory says managers should act in the best interest of shareholders. They should work in such a way that the interest of the shareholder can be improved, increased. They will get the maximum benefit. But what is the actual situation? The actual situation is managers may maximize their own wealth at the cost of shareholders. How? They are going to get higher salaries, higher perks if they are able to show higher profit in the financial statements. So instead of distributing profit to shareholders, it is better to show, from the manager's point of view, it is better to show higher profit in the financial statements. In this way, the top management will feel happy that our manager is able to increase the profit. But the theory is we are losing for long term because we are losing the interest of shareholders. Now this clash, this difference causes a cost which is known as agency cost, and this problem where the manager is in dilemma is called agency problem. Okay, so what is an agency cost? An agency cost is a type of internal company expense. It is internal to the company, which comes from the action of an agent acting on behalf of principal. Okay, agency cost typically arise in the wake of core inefficiencies, dissatisfactions and disruptions such as conflicts of interest between shareholders and management. Okay, when their viewpoints are not matching, then this kind of cost occurs. Now how we can avoid this cost? Okay, this type of cost can be avoided by giving ownership right to the managers. Give some shares to the managers. Okay, now what will he do? Now he is also shareholder, he is also owner of the company. Now he will work in best interest of the shareholders as well. Okay, this can also be avoided by providing managers with some kind of incentives. Close monitoring by stakeholders and board of directors can also lead to reduction in agency cost. So, my dear students, as we come to the end of today's session on the fundamentals of financial management, I hope you found this session insightful and enriching. Today, we have delved into bedrock principles that unpin sound financial decision making. Now, before winding up, let us quickly take a moment to recap what we have learned today. We explored the concept of finance, financial management, the art and science of managing money effectively. We have discussed the relation of finance with other management functions and how the role of financial manager is changing with time. We have seen how focus has been shifted from profit maximization to shareholders' wealth maximization. We have also seen what is agency problem, what is agency cost, and how we can reduce or minimize this cost. Through mastering these fundamental concepts, we empower ourselves to navigate the complex world of finance with confidence and clarity. So as we conclude today's lecture, I encourage each one of you to carry forward the knowledge and insights gained here into your personal and professional lives. Thank you for your attention and engagement throughout this session. I wish you all a very best in your financial endeavors. Have a wonderful day ahead. Thank you.